You can master delta. You can understand theta. You can study implied volatility. You can map support and resistance perfectly. And yet, you still close your best long-term options the moment they turn green. Why do we do that? Why does profit sometimes feel like danger? Today, I want to talk about something that has nothing to do with technical analysis and everything to do with psychology. Because the biggest gains and leaps are not lost because of bad entries. They are lost because we exit too early. 1. The battle between math and emotion. From a mathematical perspective, long-term options are built to capture trends. High delta means you participate meaningfully in the stock's move. Long expiration dates give your thesis time to develop. If the company is aligned with long-term growth themes, like AI, cloud, or digital transformation, then time is your friend. The math makes sense, but our emotions don't. Our emotional system is not wired for compounding. It is wired for survival. When your position turns green, especially quickly, your brain doesn't see the beginning of a long trend. It sees something fragile. It whispers, "Take it now before it disappears." That's the conflict. Your strategy says, "Be patient." Your nervous system says, "Secure it." Most traders listen to their nervous system. Strategic investors learn to override it. 2. Why profit feels like a threat. Here's something interesting. When we are down on a trade, we often give it time. We tell ourselves the thesis is still intact. We are patient. But when we are up, now we feel pressure. Now we have something to lose. Unrealized profit creates tension. We start imagining how bad it would feel if the gains disappear. That fear of regret pushes us to sell. And when we sell, we feel relief. We feel responsible. We feel smart. But often we didn't sell because the thesis changed. We sold because the discomfort increased. This is the hidden cost of long-term options investing. Not slippage, not volatility, but emotional impatience. 3. The land grab mentality. To hold long-term options properly, you need to reframe what they are. A leap is not a short-term trade. It's not a weekly bet. It's a strategic land grab. Let me explain. If you bought land in a city that you believed would grow over the next 10 years, would you sell it just because its value went up 8% in 3 months? No, you would hold it because the thesis is long-term. Deep in the money leaps are similar. When you buy a high-delta, long-dated option in a strong company, you are not trading daily noise. You are positioning for a structural story. Daily price swings do not invalidate a multi-year thesis. The land grab mentality replaces reactive behavior with strategic patience. 4. Compounding delta is the real edge. We often talk about delta like it's just a number. 0.75, 0.80, 0.90. But in a strong uptrend, something powerful happens. As the stock rises, your deep in the money leap can move closer to 1.0 delta. It starts behaving more and more like stock, but you used less capital. That's where asymmetry develops. Not from quick 10% flips, but from allowing exposure to compound over time. And compounding requires one thing: time. If you exit the moment you see green, you interrupt the compounding process before it even begins. Large winners rarely feel comfortable while they are building. They feel extended. They feel fragile. They feel like they could reverse any moment. That discomfort is not always a sell signal. Sometimes it's just the cost of staying aligned with magnitude. 5. A disciplined holding framework. Holding blindly is not discipline. Patience needs structure. Before I enter a long-term leap, I define the thesis clearly. Why this company? What structural trend is it aligned with? What is my time horizon? When the position turns green, I do not ask, how much am I up? I ask, has my thesis changed? If earnings continue to confirm growth, if the balance sheet remains strong, if the macro drivers are still intact, then short-term volatility is noise. And I remind myself, if I bought a 24-month leap based on long-term AI growth, it makes no sense to treat it like a 3-week swing trade. Time was purchased intentionally. It should be used intentionally. 6. Rewiring the emotional reflex. Selling winners too early is not a technical problem. It's emotional conditioning. We are wired to secure gains quickly. Historically, that improved survival. But markets reward something different. They reward patience aligned with probability. So we need a new reflex. Instead of asking, what if I lose this gain? We ask, what if this is just the beginning? Instead of reacting to daily price moves, we respond to changes in thesis. This is the shift from trader to strategic investor. It's not about ignoring emotion. It's about understanding it well enough that it doesn't control you. So the key takeaway here is, beyond the Greeks lies something more powerful than calculation: emotional endurance. You can structure the option perfectly. You can select the right delta and duration. You can time the entry well. But if you cannot hold through discomfort, you will never capture true long-term compounding. Long-term options are not just financial instruments. They are patience instruments. Massive profit is not a threat to survival. It is the reward for surviving your own impulse to exit too early. As always, this is not financial advice. It's simply the framework I use to align math with discipline. Stay patient, stay thesis-driven, and allow Delta the time it needs to compound. I'll see you in the next video.